UK retail investors have been failed as a whole by governments, regulators, and the investment industry over the past 25 years. Pension pots are considerably smaller than they might have otherwise been, while savers in tax-free ISAs huddle in the safety of cash, all but generating a fall in their future purchasing power after inflation. Why? Well, a range of factors came together in the earlier part of the century to deem shares and stocks too risky for the average citizen. The investment industry, which prospered from the 1950s to 1990s by broadly investing in shares of profitable companies, was dragooned into buying bonds, initially for its large pension fund clients and laterally for its private customers. Okay, what's the big deal? What's the difference between shares and bonds in the first place? Well, shares offer you an unlimited participation in the future profits of a business. Bonds are a loan to a company or a government. A good company will pay you some interest for the use of your money and will pay you your money back at the end of the loan term. It's a bit like paying off your mortgage or your car loan. Once you're done, you're done. The bank doesn't get another cent. But if you'd given the mortgage lender a share of your house and the value kept going up, you'd be paying back the bank in perpetuity. And that's what's great about owning shares. But if that's the case, why would anyone choose bonds at all? Well, the early 2000s saw a crisis in the dominant type of employer-sponsored pension schemes. Those which promise to pay you a fixed percentage of your retirement salary as a pension for life, and usually with a 50% continuation for your spouse after you'd gone. These were called defined benefit schemes and were overly generous from what most companies could actually afford to do. This forced some companies to close entirely and most to change to a scheme where the final pension wasn't a function of your earnings but the result of your investment gains over the period that you and your employer paid into the pension. If you're working privately in the UK right now, you presumably will be paying into one of these pensions. So here's where we get the brains of the actuary profession coming into the fray, with liability-driven investment. On the face of it, this sounds attractive. Pension funds should aim to match their future payments to pensioners, their liabilities, with cash flow assets to match. Trouble is, no one knows what the exact value of a share will be in 30 years' time. Sure, you can try to estimate future sales and profits, but by the time you get to year 20, completely impossible guesswork. And actuaries do not like to guess. So they turn to bonds, where you don't have to guess. You can put all the numbers in a well-behaved spreadsheet and crank out your future cash flows. This seemed to work well, as cheap goods from China brought down inflation across the world, allowing interest rates to come down globally, with the mirror impact of pushing up the value of bonds. This is an important relationship in finance. Interest rates up, bond values down. The trouble was, when COVID impacted the global supply chains, inflation came roaring back to the financial system and interest rates had to go up to squeeze it back out. So when the interest rates went up, all the assets held by these fancy liability strategies were 20% or so down. Meanwhile, what happened to the stock market through all this time? Well, this.
It was actually a better day on Wall Street.
The gains recovered about half of the market's historic losses from yesterday.
So in a period where the stock market has gone gangbusters, these liability matched pensions have not. So that's your pensions. Well, what about your investments? Let's say you had gone to a reputable national stockbroking firm looking for advice on where to invest your hard-earned savings. It used to be that a stockbroker would buy you stocks, but somewhere along the line, brokers started reading academic research about share prices. And here we run into the same problems we did with actuaries. Most ordinary people think of financial risk as the likelihood of losing your money outright forever. In other words, a permanent loss of capital. But academics can't put that in a formula. So they decided that risk-free investments were the ones where you were guaranteed to get the face value of your money back, say government bonds. And that what made investments risky was not knowing what you might get back at the end of a period of time, good or bad. In other words, the price could be higher or lower than when you originally bought it. The more that the possible outcomes varied, the riskier the investment. And guess what? Because the prices of shares in a publicly traded company changes all the time, these were the riskiest investments of all. So for academics, volatility equals risk, just directly. The fact that a share price could double over 5 years didn't matter at all. If it was going to move a bit sideways, a bit up or a bit down, maybe not move anywhere for a while before it doubled in value, doesn't matter, it was a risky investment. Now in theory, the stockbroker's job was to help clients structure a portfolio of shares in a way that diversified risk. Instead, they picked up on the idea that risk equals volatility and duly invested their clients' money into bonds. So the people who couldn't bear much of any loss of permanent capital ended up with portfolios full of bonds just as the prices fell in tandem. Now, the nail in the coffin of private client investment in shares came from overly zealous government regulation, which took the notion of shares as risky investments at complete face value. Severe penalties were imposed on investment firms falling foul of what became known as the suitability rules. Essentially, firms had to assume that clients viewed shares and related investments in the same light as building society deposits. Only clients with very long-term horizons could be exposed to the horrific idea of a temporary loss of value in their share portfolio. Investment in blue-chip company shares was therefore only suitable for a handful of buccaneering millionaires who might not faint when their quarterly statement dropped through the letterbox. And so where did this leave the poor, frankly misled client who was simply interested in owning shares of the very successful companies whose products and services they use all the time? Well, considerably poorer than they might have otherwise been. So private clients were pushed away from all the benefits that we talk about in this channel of owning high quality shares for the long term, including the benefits of the internal compounding of the money within the business, as well as the benefits of any shares dividends that they might have received. So the aim's to be super safe, to try to beat inflation or at least match it. People have been pushed away in private client side from the benefits that we extol on this channel of owning shares for the long term. Better beats inflation than bonds do. Of how these companies, the great companies, can reinvest the money they make into better products, better services to make more money and more returns in the future, to grow the value of the business, all of which you benefit from while you own the shares. And they will also likely pay you out dividends, which you can then yourself use to compound your own holdings. There is so much lost by owning bonds over owning these businesses over the long term. And in many cases, for us at least, it's been regulated that we must tell people to not own the exact things that we want to tell them they should own. The things that we know through years and years and years of evidence are the best suitable thing for most clients, for most people, which is why we're now telling you. In a professional capacity, we're often stopped from fully saying what we would like to say because of these regulations, because people who don't really know what they're talking about are telling people who do know what they're talking about that actually the greatest companies in the world aren't good investments for most people. Nonsense. The massive benefits of a diversified portfolio of high quality shares beat the brakes off of owning bonds. They just do. There's a place for bonds in a diversified wealth portfolio, but they're best suited, funnily enough, to a handful of circumstances, and certainly not the majority. But the way things are in private client investment in the UK, with pension fund investment in the UK, unfortunately, we have largely been forced to fail our clients. We hope you enjoyed this little tale from our lives, and we hope you take the lessons from it. If you want to learn more about investment, stick to our channel, and we'll see you in the next one. Take care.